Hey everyone, welcome back to Lunch of the Market. Despite the fact that the S&P has failed to break out above its recent highs, we are not worried, and here's why. Okay, first of all, we have protection in place. We are long May SPX, that's the symbol if you want to trade options on the Standard & Poor 500 index. They're cash settled. You don't actually get the whole market delivered to you if you're long a call and you're right. And you don't get the whole market put to you if you are wrong. You just get cash taken away from you. All right, so we're long the SPX 1300 1275 put spreads, meaning we're long at 1300 and short at 1275. Obviously, max profit is if the S&P falls all the way down to 1275. That's a long way for it to fall from here, so we're hedged and well. Okay, we're also long VIX call spreads out to July. We're long the 2024, okay? The opposite of, right? So on the call spread, we're long the lower strike and then short the upper strike, as opposed to being long a put spread where you're long the higher strike and short the lower strike, okay? Call spread, put spread. Call spread 2024, put spread 1275. Those are our hedges. That'll get us through sell in May and go away, which is the seasonal weakness that we may be concerned about, and it'll protect us from any kind of technical damage that's done by the market. Meaning, if you take a look at the chart of the market, it flew up, hit around this level, failed miserably, traded back up, and now we're just kind of bumping our head along the level. Some might be calling for a double top. That's fine. If that technical pattern emerges and we see a double top, at least for right now, we're hedged. Okay. Second of all, we have cash. We are flush with cash in all of our accounts that we manage. We're sitting on at least 10% cash position or better in some cases. In some cases, it's 20%. Okay. That means that we can be advantageous when something goes against us, when the market does something we didn't see. We've got cash to make decisions. Third, individual stocks that we retained are collared, right? No, that doesn't mean that we put a tie on them and post them up on the board. It means that we're short a call and long a put below it. We use the proceeds from the call that we sold to then go out and buy a put. This means that if our stock trades up and gets called away from us, muy bueno, that's what we were looking for anyway. We also retain the right to move that call up and out should we want to stay in the name further, like DBO or SLV, right? That's the PowerShares ETF that tracks oil, or the iShares ETF that tracks silver. We roll those up and out to next month from April, bing, so that way we get additional upside. For the DBO up and out roll, we only paid about 23 cents. So we got another additional dollar of upside because DBO is already through 33. We were short at 32. Now we're short at 33 call. We gained an additional dollar of upside, but we only had to pay 23 cents for it. So clearly the risk reward is there. Okay. On SLV, we gained $2 of additional upside and we paid 0. That's right. We did it for flat or for even, meaning some market maker out there took the potential profit we could have had, but the reality is we got $2 of an additional upside and paid $0 for it. That, my friends, is a good trade. All right, so individual stocks have collars around them. If it goes bad, terrible, horrible, then we exercise the put part of it and we make somebody else take our stock that we don't want anymore. Therefore, you guessed it, raising even more cash. So again, cash is key, hedges are key, hedges are key. And look, it's unhealthy for the stock market to run into earnings. If the stock market runs into earnings, then you're just going to get a sell on the news event. We would rather see the market flat or down into earnings, then see better than expected earnings, then see the stock market rally as it prices in the new forward earnings guidance that we get out of the companies that we're investing in. So it's actually kind of healthy to see the market pull back or at least trade sideways into earnings. Earnings start next week. So for all of those reasons, and because we've got tons of hedges on, we're comfortable, right? We're not going to force a trade. We're not going to try to make something happen. We're not overly concerned about macro world events and oil and government shutdowns and war. We're cool, right? So if you're not hedged right now, no problem. The VIX is relatively low. It's at the bottom of the most recent range, meaning you can still buy your hedges and not spend a boatload of money doing it. Instead of puts, right, If you don't like the collar trade, if you don't like giving away your upside, take a look at what we've done with Marathon, ticker symbol MRO. Look, there's been a lot of talk about the refiners and people kind of being done with the refiners. There's a huge differential between WTI crude and Brent crude. That WTI just stands for West Texas Intermediate. There's a huge differentiation between those two spreads. And refiners have basically bought the cheap stuff and sold gas to you at the high end of it because everyone knows that oil is high. And obviously it's been a great business, but look, we've sold calls against our Marathon position, which means we squeezed a little bit more profit out of it. The problem is if you're just long a covered call, meaning you're long a stock and sold a call above it, the problem is your downside is completely and horribly and nastily unprotected. So we put together a put butterfly, which we've talked on the show lots of times. 50, 45, 40 put butterfly. We paid 68 cents to protect our Marathon. We're up 50% and we only paid 68 cents. Look, we didn't give back anywhere near the gains that we have in that position right now. But we're protected for 68 cents and we're protected all the way down to $45. The stock's trading at 53. Right? We're protected for a long, long way. So take a look at doing something like a put butterfly if you want to maintain a long position. That way you use the bottom half of the butterfly, this half, to make it cheaper to buy the top half, which is your put spread, which is your real protection. Okay? For more on put butterflies, check out yesterday's episode of Lunch of the Market. You can find it on Stock Picker. How do you get to Stock Picker? Just go to magnumopusfinancial.com. Right at the top, you're going to see a strip that says Lunch of the Market. You click on the Lunch of the Market page or go to magnumopusfinancial.com/lunch. At the bottom, there's the live stream. You can watch us live right there on the Lunch of the Market page. There's our old videos, our archives, and right below that is a link directly to the Lunch at the Market page on Stock Picker where you can get all of our back issues, right? Where you get this in writing, right? Some people like it in writing. You can get it magnumopusfinancial.com/lunch. Look for the Stock Picker at the bottom of the page. You can get this in writing. All right. We also have our eye on CRE. The sell-off today is actually taking place on low volume. This is really the first time we've seen CRE move meaningfully, but it's been on low volume. In fact, how low? Last Wednesday when the stock got obliterated and traded down to the bottom of the channel, basically to support, it tested support on 16.61 million shares of stock changing hands. Okay, today's volume, we're mostly through the trading day already, was only 1.98 million shares. That's pathetic. It's anemic. So the reality is that whoever's selling it's doing so without the conviction of everyone else that holds the stock. Okay, so that's some pause to take. Second thing is that bottom of the channel has held pretty well. It held extremely well. The stock traded all the way from 42 and change back up to $46 a share, and we're now around 44 and change or so. Okay, and it's on low volume, so somebody's whipping the stock around with really nobody else participating. Everyone else is kind of already has their position, and they're waiting for earnings, which are on the 19th. Now, here's another telltale signal: options. The Bollinger Bands didn't explode today, okay? Which means that the options traders have already placed their bets on CRE. Wonderful. So the smart money is staying put. It's very low volume. Don't get concerned, at least about today's move. You can get concerned on the 19th after you see earnings, either good or bad. But for right now, it doesn't look like there's a reason to panic. So sit tight if you've got a position. And of course, ours is the long put butterfly in May, where we're long the 45, 40, 35 put butterfly that works just like the Marathon put butterfly we just told you, or the Decker's put butterfly that we did in the video. You get the point. You should learn how to do the butterfly. Remember, check out MO Financial and DECK. Put those into the YouTube search bar and you'll find the video on put butterfly. All right, thanks for joining us again today. Be on the lookout this weekend for 3 new episodes from America's Favorite Traders. Zach Carabell, Pete Najarian, and Dan Fitzpatrick were all on our show this week, and they're all fabulous. Thanks for tuning in again today. Have a great day, and we'll see you tomorrow.